Hey, everybody, welcome to 2026 Note Investing Lunch and Learn. Did I say that right?
You absolutely did.
There's like a whole lot of words in there all of a sudden. I'm like, am I in the right year? I'm in there, but I'm Fred Rui and
I'm Tracy Z, and we are so happy you joined us today. We get to talk about something we love, and that is note investing, and we love sharing it with you. We've been doing this a while.
Yeah. You can't lead with the years. I mean, I feel so.
I can if I want. Okay. I earned all those.
So we have been doing this, believe it or not, we've been doing this for over 30 years, actually getting closer to 40 years now, which I don't even want to say that, but we've been in this industry a long time. It's what we've done. It's what we've always done. It's always been our primary source of income and fun. And we've seen all markets. And so what we like to do is we like to do what's called lunch and learns. And we don't do this very often, but we like to basically go, look, anybody that wants to know about the note industry, you know, we're not holding anything back. We're literally going to do 4 to 5 sessions where we walk you through exactly what the industry is, how you make money in the industry, what notes are, how you find notes, how big is the industry, all that stuff. We're going to walk through it, and we're going to answer your questions because we're doing this live, which means if you leave questions, I think in like several different places, I'm seeing lots of questions come up.
All right.
You know, from different people. I'm seeing them from Facebook. I'm seeing them from LinkedIn. I'm seeing them from other places. So yeah, we're super excited about that. And we're going to jump into the PowerPoint, and there we go.
We're just going to kick it off. We believe in delivering good, solid information. Everybody's busy. We respect your time, and we are excited to share the industry with you. So how note investing really works. As Fred mentioned, we're going to cover some good stuff today, starting with why we still love notes after all these years.
All these years.
Still crazy after all these years.
Yep. We're going to talk about owning real estate versus notes. Some of you on this might be people that actually own real estate, and trust me, we've been there. So we're going to talk about the difference between the two.
The 3 main sources of notes.
How big is the industry? Flash. Spoiler alert, we literally are crunching the numbers for last year right now. We just got them. So you're going to be the first to see it.
And a note investing case study, because I think we all learn best by seeing real deals.
Yep. And we're going to talk about making notes for you to work in 2026 and beyond, actually.
Yeah, not just about us, but how you can make notes work for you.
It's really about you. It's more important. Limited liability disclaimer. You've seen these. So we're not attorneys. We're not investment advisors. So, you know, this is informational purposes provided to help you understand. We can't give you legal advice. We can't give you financial advice, but we can tell you exactly what the industry is, and we can tell you exactly what we do in it and what decisions we would make. So why do we love this after 30 years?
Well, we own an asset that has monthly income that is backed by real estate, but we don't have all the headaches of real estate. But number one, it's an asset that's backed by something we know, we love, we can underwrite, and that's real estate.
Yep. There's great returns. It says good returns there. I'm going to say great returns.
You know, I'm always an understatement.
I know, but I mean, even at the basis, I'm like higher than any CD or even anything walking into a bank. Even a lot of stock returns have been.
It's less hands-on than managing real estate, and you can manage it from anywhere. And this is one of the things we really love, because we love to travel. And with the advent of the internet, we've been in the note business before and after the internet, we can tell you it's a whole lot easier to manage notes from anywhere.
Yeah, without the internet, we couldn't do it in the middle of the Atlantic Ocean, which we've done. So yeah, there's a lot of creative options. Yeah. I mean, I'm the first to admit I have a short attention span. And no. I do, believe it or not.
Fortunately, after all these years, I still have your attention.
What were we talking about? Oh, anyway, so it's a lot. You're going to see as we go through deals, particularly when we get into case studies, there's a lot of creative ways to help people and a lot of creative ways to work yourself into a deal. And I like that part.
One of my favorite topics is how to harness the power of interest. I love compounding interest, and that is what we put to work when we use note investing. We take all the scary math out of it and really show you how to approach it.
Yep. And we're going to talk about controlling your investment level. And this is actually one of the coolest things. We won't get into it today, but we will in I think one of the next ones.
Yeah.
You know, you get to pick a lot of things. A lot of times you do investments and you don't get to choose anything. You get a lot of control over how much you're going to invest, what return you want, what types of properties or what types of notes you want to be involved in. It's very, very empowering.
I always say I have control issues.
No, no.
And I'm okay with that. Nobody
Yes.
minds your money like you do. And that's one of the things I like about note investing is you get to control your level of investment. You get to control the investment.
Oh my gosh, I just realized that we're a couple that have been married a long time and you have control issues, but I have short attention span. So that's why it works.
Is that why it works? All right. Well, see what we just
Because I forget that you have control issues.
Yeah. Oh, interesting. All right. This is not couples therapy.
That
This
is not. It is
therapy.
not. Last but not least, tax deferred or tax free. Especially we talked a little bit about self-directed IRAs. This is where you can actually buy notes out of a self-directed IRA, and the returns go back into the IRA. And a lot of those have no limits to how much they can grow. Sometimes they're tax deferred. Sometimes it's tax free. If you talk about a Roth, which is post-tax dollars, so these are super, super powerful vehicles.
And you could do this inside an IRA or 401k or outside.
We do both.
We do both. It
Yeah.
depends on what your objectives are, money today or money tomorrow. Of course, we love self-directed IRAs because of the tax benefits. But
I thought you were going to say we like money today. We're just,
we like
we like
money.
both.
We
I
like
like
both. Yeah,
I like
that's
both.
fair.
I like where the money
All
gets.
right. So how did we start?
How did we start?
All right, we started. We both started separately in this industry. When I started in 1988, I worked for an institutional note buyer, like a big note buyer that packaged these up into mortgage-backed securities, and they wouldn't let me buy notes. I did that for 10 years with them, but they would allow us to own real estate. So I'm like a lot of people. I'm like, oh, I want to own real estate. So I bought a property, lived in it, and sold it. Then I bought a fourplex and lived in it and rented it out. And I was on this real estate train, if you will. And I was doing that while working full time and being a single mom at the time.
Mhm.
And let me tell you, I was really tired of being a real estate investor because I knew working in the note business how great notes were. Now you had a little different start.
Well, I mean, I started trying to figure out how to buy real estate. I was living in the Bay Area on the West Coast, and I was trying to figure out, like, how am I going to be able to afford real estate? And then when I finally got to that point, and then we were later, that's how we met in this industry.
We did.
And we're married, and we still had real estate then.
We did.
And then we just decided, you know what? We're just getting tired of holding real estate because, look, if you could give me real estate without any of the issues of things, without tenants, and without things breaking and without wear and tear, I'd be all over real estate. But then once you get to the other side, so that's where we were. And that's where we've taken a lot of people over the last 30 years. This has been their journey. We are people that understand real estate, understand the value of real estate. So how could we get all the benefits of real estate, but not the downsides?
Yeah, because we were burned out landlords. And what we really wanted to be was note investors.
We wanted to be passive investors. Yeah. I think even more so.
Yeah. And we tried putting our rentals with a property management company. But look, we knew about notes. As Fred mentioned, he ended up moving into Washington State and working at the same company I worked with for 10 years. And we met through there, as you mentioned,
Mm-hmm.
and we both knew the benefits and powers of being note investors. And so after working for that company, learning everything we could learn from them, we decided to start our own company and go on our own note investing journey so that we could own notes.
Yeah. So up until that time, we were buying notes for other people, for large corporations. So we walked from all of it to start our own company and to buy notes ourselves. So I think we really want to real quick step back for just a split more second, because in this episode is about getting everybody on the same page.
Yeah, let's do that.
And talk about the difference between being a real estate landlord, meaning you kind of own the property, and a real estate note lien lord, which we say lien lord, but basically you're acting as the bank. There is no bank. And if you don't understand that, that's okay. We're going to break that down in just a minute here. But we want to talk about the difference between being a landlord versus a lien lord.
Yeah. So a landlord, pretty much a lot of people are familiar with that. You own the real estate. When you own a note, you're a note holder like the bank, as Fred mentioned. So let's just kind of break down the difference. With real estate, you own the property. That's the sticks and bricks. Mm-hmm. But when there's a real estate note, you own the paper. You hold the promissory note and the mortgage and the deed of trust against the property like a bank.
Right.
So you have the right to collect the payments, but not live in the property or use the property.
Yep. And like Tracy said, when it comes to the deed, basically the real estate, you have the deed to the property. The difference being is that, you have to make the payments on there until you basically, then the property becomes yours. With real estate, you're the bank side. So you have the note and mortgage or deed of trust, if that's what you're in a deed of trust state. And it's just a paperwork semantics, but it makes a difference of who really owns the property at what point.
when you have real estate, you have tenants that hopefully make rental payments to you. And we all know tenants don't always treat property like it's their own. Once in a while, you'll get that golden tenant who does. But when you have a real estate note, the owner of the property, whether that be the person living in it as their own home or the landlord that's renting it out, either way, you have owners, people who have pride of ownership because they own the real estate. So I like being a bank because I'll have owners living in there, not tenants.
Mhm. So when you have real estate, and it's assuming we're talking about the real estate that you don't live in personally, that you rent out to somebody else, basically you have rental income. Every month you have tenants, and every month, and this is probably the best part of having real estate, right? If you have tenants that are there. So you have rental income
Good
coming
tenants.
in, good tenants. If you have a real estate note, you basically have interest income. They're paying you the principal of the note and they're paying you interest, but basically it's like giving a loan to somebody or extending credit to somebody. They're paying you off instead of a bank. So there's just a difference between rental income and interest income.
With real estate, you might use a property manager or you might manage it yourself. With real estate notes, we use a loan servicing company licensed in the state where the property is located that collects those payments on behalf of the borrower and sends it on and keeps track of things like taxes and insurance. Speaking of which,
Yeah. So if you own the real estate, you're the one on the hook for paying the real estate taxes.
and boy, are they going up. in a
Whatever
lot of
taxes there
places.
are, but you're going to certainly be paying the real estate taxes every year because you're the one that owns the property, and that's who has to pay the taxes.
With a real estate note, that owner pays the taxes.
Yeah.
And you can escrow for them, require them to pay into an escrow. So you're making sure they're always paid.
Yeah.
And-
Same thing's going to be on insurance. So insurance, basically, that if you're the one that owns the property, then you're going to pay the insurance. I mean, no one's, if you're paying money to a bank, your bank is not covering the insurance. You may have an escrow account where they're holding it for you, but it's still your money.
Yeah, and with real estate notes, the owner of the property pays the insurance. And we are currently located in Florida. We've lived here over 20 years now, and we travel a lot, but that's kind of our home base. And we know about rising insurance costs, and a lot of landlords are really feeling that. And so it's nice as a note holder. We feel for the people making the payments, but we are not as worried about those increasing insurance costs.
Mm-hmm. Yep. If you own the real estate, you need a new roof, guess what? You're paying for a new roof. You need plumbing done, guess what? You're paying for plumbing. So you cover the maintenance costs, and there are always maintenance costs at some point on any piece of real estate. If you're the one that owns it, then you're the one paying.
And so let's kind of look, now that we just established the difference between the two, let's look at it in dollars and cents.
Yeah. So this is actually, we're looking at everything based on cash flow, right? So this is how much. So maybe you have a real estate property that you're renting out, or maybe you purchased a note or created a note on a property, and what's the average difference on there. So let's just say that the monthly cash flow on both of these is $2,000. If you're renting it out, you're getting $2,000. If you have a note, you're getting $2,000.
If you had a property manager, let's say on average they charge 10%, that would be less, $200 a month. But with notes, we don't have a property manager. As we mentioned, we have a servicing company, and they average somewhere between $25 and $40. We use $40 as an average servicing fee, assuming you've got some escrows on there for taxes and insurance.
Yep. And property taxes, and this is just an arbitrary number because it's going to be different for everybody. So let's just say $300. Let's say your properties are $300. If you have the real estate, then you're going to be paying the $300 every month. If you have notes, then that is going to be the responsibility of the payer or the person buying the property. Same
goes for the insurance. If you have a $2,400 your insurance bill, you break it down monthly, $200. That is what you owe on real estate. On notes, you don't owe that because your borrower is paying that.
Yep. There's a maintenance reserve, which you should be doing if you have real estate, because
a lot of people don't, but you should.
A lot of people don't, but at some point you're going to have to put on a new roof. You're going to have a plumbing bill. So usually the general average is to be putting away $200, and that's not $200 that you're going to get back. That's $200 that's going to go towards some sort of repair later. If you are holding the note, then you don't need a maintenance reserve because you're not going to be the one responsible for the repair.
If you use a 5% vacancy allowance on rentals, that would be an average of $100 a month. Of course, that doesn't happen just $100 a month, but if you're reserving for that, that's an average number. We don't have to worry about that with notes. And so when you deduct all those expenses on the same $2,000 income, you can see you're netting, if you're fortunate, $1,000 a month. That's before you've even paid your bank. Let's say you also still had a bank loan. You're only netting $1,000, but with the notes on the same note, with only that $40 servicing fee, you're netting $1,960 every month. that's $960 more a month.
Yeah, and your numbers could be slightly higher. Certainly, if you start talking multiple notes or multiple properties, slightly lower. Maybe if maybe you don't have a property manager, maybe you do it yourself, but you can't have a whole lot of properties and be doing it yourself. So this is just on average. You can see why Notes is enjoying the cash flow side, not necessarily the maintenance and cost side.
Yeah, and the only real negative is that when you don't own the real estate, you don't get the appreciation
That's true.
and the depreciation for tax purposes. One of the reasons we all love putting notes in those self-directed IRAs. But you can see long term, depending on where you are in the stage of your investing career, that while a lot of people move from real estate to notes, it's not that we're against real estate. It's just at this stage of our life, we very much like notes, and we have for over 30 years, and we've always had a portion of our portfolio in notes, and now we're fortunate enough that we like just notes besides real estate that we own to live in. Right?
Yeah, and there's a good argument depending on what the value goes up on. Once you've paid all these things, everybody thinks of like, well, I made $50,000 on my house in the last 5 years. Yeah, but what did you pay on your house in the last 5 years? And so and obviously there's an upside there, but as the markets go up and down, it's not. So let's talk about notes. Let's just talk what a note is.
It's really a piece of paper that's a promise to pay.
It's just a promise to pay. It can be written on a napkin and actually still be legally binding.
If it had the right terms.
So it's just an agreement that the borrower or the buyer agrees to pay so much dollars a month at so much interest rate over so many over so many months, and they sign it, and it's almost like a check. It's almost like it's an IOU that is written. So that's all a note is. So that's what we're doing. And that's the binding piece of paper, along with a couple other ones that we're looking at. When we talk about buying notes, that we're buying the IOU. We're buying the debt.
Many of us are familiar with notes. So we're going to talk about three main sources of notes. Probably the one you're most familiar with is actually number 3, which is a bank note. When you go to a bank and you borrow money to buy a piece of property, and you sign a note and you give them a mortgage or a deed of trust as a lien against the property. And we sometimes in the note investing world, we don't often see bank notes, but sometimes we'll see them in the form of non-performing notes where people aren't paying anymore, or reperforming where they weren't paying and now they are fallout from the secondary market. And so, but the bigger portion of notes we see are seller finance notes. Mm-hmm. And we'll go into that, but just describe briefly for people what seller finance notes are.
Well, I mean, we're gonna do an example right now, but basically a seller finance note is, I agree to sell the property to you. You're going to make payments to me. There's not going to be any bank involved or anything like that. Maybe I have a piece of land that you want to buy. And there's a whole lot of reasons we're going to go into in just a second, but basically that's just one person selling to another. We didn't involve in a bank. You may give me a little bit of a down payment and we agree on the note. And so that's going to be seller financing.
And then some people create notes. They either make loans, private loans against them, or they take real estate they own. If they're a landlord, they sell it and take back financing and create their own notes. So those are the 3 main sources of notes. We're going to spend a lot of time today talking about how notes are created and what seller financing is. So notes, here's how a note's created when it just involves a bank. You've got Sam, the seller. He sells the property to Barb, the buyer. She goes out and gets a bank loan. Sam, the seller, gives the deed to Barb, the buyer. She signs a note to the bank. And she makes payments to the bank, and Sam, the seller, gets his money and he's happy. And so we're all familiar with that. But how about seller finance notes? How are those created?
Yeah, so seller finance notes, we're basically just going to remove the bank. Sam, the seller, steps into the exact spot the bank was. He has all the rights the bank had. So in the event that the buyer does not make a payment, the banks have a right to take the property back. Same thing happens here with Sam Seller. If the payments don't come in, he has those same rights. But the good news is that he's also going to get the interest or the return that the bank would have. And that's why they're in business, right? So she's going to make payments to him every month. There's also going to save on some closing fees and everything else that go along the way. And it happens all the time for a variety of reasons.
And then Sam, the seller, could get tired of receiving those monthly payments and want to cash out for some reason. So he is acting like the bank, getting the payments from Barb, the buyer, but he gets this letter or goes to a real estate investors meeting, and there's somebody there that says, hey, we buy notes, or we work with investors that buy notes. And a note finder might reach out to Sam, the seller, and they say, hey, we can connect you with one of our funders who would give you cash now for the right to receive those remaining payments on the note from Barb, the buyer. Mm-hmm. And that funder basically would pay Sam the seller. They would take his place through an assignment of the mortgage or deed of trust. They take the place of Sam the seller, and now Barb the buyer, nothing changes for her except where she mails her monthly payment, and that would be to that funder.
Mm-hmm.
So that's the industry right there. You might be Barb the buyer, you might be Sam the seller, you might be a note finder, you might be a note investor, but those are the main players in the world of note investing.
Yeah. Someone asked if it was are note investments best for single family homes rather than multifamily. It's both. Yeah. It's both. We do both. We see more single family, but that doesn't mean the multifamilies are not good. And we're going to talk about that later on deciding what type of properties we want to do. So why seller finance? Why would anybody, why would he carry back a note? And there are several reasons that someone might do that. The first one is, and the most popular is a buyer issue. So roughly 12% of all buyers, believe it or not, are turned down for conventional loans. In some cases, it's much higher depending on a demographic or an age or anything like that. But, you know, if you're self-employed, that could be a reason. There's a whole lot of reasons that there are still good buyers that don't qualify for traditional financing. So one of the reasons just might be is that they didn't qualify for a bank loan and you still want to sell the property.
Yeah, if they had a good enough down payment, or if there are reasons they weren't qualified were good enough. We do see some people with no credit or poor credit, maybe from a medical reason, that have gotten back on track. As Fred said, maybe they haven't had W-2 income for 2 years, but it could be some kind of buyer issue. Another issue might be property issue.
Yeah, and this might be, you know, it might be a specialized property, maybe very rural. It may be a large, older property. It may be a property that's not normally insured very easily, or banks just don't like to lend on.
Mobile home and land.
Mobile home and land, an older mobile home. There could be a reason. That might be one reason somebody wants to carry back a note.
And sometimes it's a well thought out investment strategy. Someone says, hey, like Sam the seller, I've owned that property. I've seen a lot of appreciation. I'm ready to sell it and get interest income and become the lien lord instead of the landlord. And I'm going to do an installment sale so I can defer the capital gains on that property. That's a section of the IRS code. There's lots of reasons that people can think out. They say, hey, I'd like to get interest at 9 or 10% backed by real estate. And so that well thought out investment strategy is another reason.
Mm-hmm. Yep. So real quick, let's just talk about how big the owner finance market is. And it's roughly 3% of all real estate transactions. And we're just going to kind of show the numbers and all. But the big takeaway from this is there's more notes created than we can buy. Yeah. But they're not all buyable. So there were $29.5 billion in notes in 2025 created. We can't buy all of them. They're not all buyable, but there's more than enough notes out there. If you go over the last 5 years trailing, which is what we tend to track these numbers every year, there's roughly $137 billion with a B created over the last 5 years.
Yeah, that's more than we can buy.
Yes.
That's more than most people could buy. So, people say, well, why do people talk about this and share this information? Well, there's more notes out there than a private investor can buy. And by all of us learning about this and networking, collaborating together, we all have more opportunity to find these notes and place them with an investor.
Yep. Someone asked, how and where are you going to find notes? We're going to do an entire webinar showing you exactly where to find notes.
Absolutely. Yeah. That's our how to find notes. I think that's the third one.
Third one. Yeah.
All right. So we won't spend a whole lot of time here, but we just kind of wanted to show you that when we track these numbers and we pay somebody to go out and analyze the data, and this comes from county courthouse records where sale took place and the seller sold the property and took back a seller finance note. So this is just, remember we talked about there were 3 areas that you could 3 main areas, categories where notes were created. This is just one of those 3 categories, the seller finance category. But you can see it happens on residential, it happens on commercial, it happens on land. And you can see the last 5 years how we get to that $137.8 billion. We'd like to break this down just a little bit more as well. And we'll do that for you here in a minute. But as we talk about trends in seller financing, just slow down a minute for me. I'm telling myself to slow down, right? And think about what's happening in the real estate market. And in the real estate market, home sales have been slow. They hit another low in 2025. And it was a 30-year low, and it was actually the lowest number of existing home sales since 1995.
Yeah, the one thing we could tell you, and I think the takeaway from this is that, and with over 30 years of doing this, doesn't matter if the market is doing well or the market is doing bad. You can see by those numbers that we just shared, it's a stable market. It's more notes than we can ever hope to buy. Matter of fact, the only thing that really changes for us in an up or down traditional market is who we're buying notes from or who's creating notes. If the market's going up, people are selling notes to get into bigger and better things. If the market's going down, then people are selling their notes because they're nervous about holding on to them, or they want to, they want to tighten their belt a little bit. And so, even with the market falling, the annual sales falling, we're still stable. We've been stable for a long time. So someone asked the question, do you anticipate more defaults in single family houses due to the AI taking more white collar jobs? Honestly, I don't, because we've seen much greater things. I'll give you an example. The COVID years, we expected defaults through the roof, and there were a ton of people not working, ton of people that had to stay home, ton of people that weren't doing anything. And we expected defaults to go very high at that point, and they didn't. So I think it's just, is AI going to take some jobs? Sure. But basically those people are going to have other jobs too. So I don't know. I mean, it would take a lot to really hit our market. If anything, it's going to make some people self-employed that are not traditional and getting traditional loans. It's going to increase. But we've been stable through everything, and I have no reason to believe that it wouldn't just continue to be stable.
Yeah, that's a really good question, which also leads us to our next slide. And we track the Mortgage Credit Availability Index. This is based on the Mortgage Bankers Association. So regular banks. How easy or hard is it to get a loan from a regular bank? Mm-hmm. And what we found was during the subprime mortgage meltdown after the 2008 to 2010, it got really, 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 really hard to get a mortgage loan, as we all know if you lived through that. Mm-hmm. And that was a time when there was a lot of defaults, like the person just asked about. Mm-hmm. And that's because unemployment was so high. So in that time, non-performing note investing was pretty popular because there were a lot of non-performing notes. So we are not expecting, but nobody has a crystal ball, that we're going to see those kinds of non-performing notes as we did after 2008, 2010. However, if that happens, one, there's opportunity to buy non-performing notes, and two, there's more seller financing, because when it's harder to get a bank loan, there's more seller financing. Now, right now, it's about as hard to get a loan as it was back in about 2013. Mm-hmm. So it's kind of stable. It got really easy to get a loan when those numbers got really high. It got really easy to get a loan when interest rates were low and mm-hmm. banks were lending a lot of money.
Sure.
Yeah. So I guess this circles back around to what you'd already said. Our industry does well in a tough economy and a good economy.
Mm-hmm. Yeah. So if we break down the seller finance usage and we're just going year by year, and you can see that we have, again, 2025, and we pick apart these numbers even bigger in our member webinars, but it's $29.5 billion in volume, roughly 87,212 filing count. Now, not everything is filed, not everything can we track, not every dollar amount, but this is generally with about, these are all first positions. Mm-hmm. They're not wraps. They're all greater than a $30,000 balance, and they're roughly limited to about 2,300 counties that we can actually get the data from.
Yes, and this is by count. As you see, the dollar amount has gone up quite a bit more because everything costs more now, right? But this is just by count. And you can see that after those 2008, 2010 years, there was more seller financing. And now we feel like it's just leveled out to what is standard. It's a very stable market. Mm-hmm. We kind of expect it'll stay there unless there's some big giant disruptor. Mm-hmm. And then it would be more demand.
Yes. So this is by property type. This is just how we break down the notes when we're able to do it. So the first category is residential, with residential reflect roughly 50% of the dollar volume, 62% of the overall count.
Commercial was about 32% of that dollar volume and about 17% of the count. So you can see, it's bigger dollars in commercial.
Yep. Land is roughly 15% of the dollar amount, 17%. And these numbers have always been the same. There is a little slush category we have here. Tracy's favorite category, the unknown.
It just means that at the county level where we grabbed the data from, it wasn't easily identifiable if it was a residential commercial land. It breaks out about the same, but just to be fair, that's how close we break down those numbers.
Yep. The only other thing is this is a very eye-opening slide, I think, for a lot of people that have a perception of what notes are or the quality of notes. A lot of people think, oh, those are all bad deals, they're all bad credit, they're all no money down, and that is not the case as far as what notes are created. Matter of fact, the average loan to value on a note created is 76%. That means it's a 24% down payment / equity in that property. That's far cry from the no money down people. I mean, the average size of a deal is 272,856. So it's gone up barely, not even 1,000, I guess, barely 1,000 since last year.
Yeah.
Year before, excuse me.
Yeah. And then commercial also, it has a 72% loan to value, so even larger down payments on the newly created commercial notes last year. That average balance is 661,996. And if some of these numbers look too big that you could buy, remember, if you find a note you can't buy, you can refer it to a larger investor and earn a fee. So just keep in mind that depending on where you live or where you want to market, because you can do this business anywhere, you can look for smaller notes if you prefer, or if you have bigger notes, you can refer to a larger investor.
Or you can buy a partial,
or
you
you
only buy a small piece of a note.
Now you're getting ahead of yourself.
Yeah, I know, but I didn't want anybody scared by the numbers because there's another trick in here. Land is roughly 73% LTV, so a significant amount of equity in there versus 69. Interesting that across the board, a little bit of an LTV change, but still plenty of equity in your average price, 286,000, which is basically in line with what it was before.
Yeah. So we like to let people know that you're looking for notes that are quality, and we're not saying, oh, go out and buy a zero down kind of note.
Right. And most of them aren't. Last bit is the types of note creators. And this is something we just kind of did for ourselves because we were kind of curious about. This comes into play when we talk about how to find notes and how you're going to find them or have people find you that know that you buy notes. And 86% of the notes created are one note within 12 months. And we call them the mom and pop sellers. These are typically somebody like lived up north, moved down to warmer weather, sold their property, carried back a note. Or some life situation, but these aren't people that are in business of creating notes. Typically, they're just creating one note within 12 months. Most of them, probably, if we could break, probably it's the only note they'll ever create.
Very true.
And then there's another category of people that create a few more notes.
Yeah, and we call them the professional note sellers. Mm-hmm. They've created 2 or more notes in the last 12 months. That's the other 14% of the market. And of that, about 7.5% of the whole created 2 to 3 notes, and about 6.5% created 4 or more notes. They're starting to get into that, professional category where they're using mortgage loan originators and things like that. But most of the people we deal with both groups. We market to them differently. You can choose to do work with mom and pop, that 86%, or you can choose to work with professionals, or you can do both. Mm-hmm. So that's a lot of information we just gave everybody, isn't it?
It is.
So how about we just do a case study?
We're just going to do a quick case study. Understand that in the other webinars, we're going to break down where to find notes and how to do the dollar amounts of them, the math behind it, the dollars behind it, and more case studies. But we don't want to leave today without at least showing you one kind of walkthrough of what this looks like.
So this was a 3-bedroom, 2-bath ranch in Dallas, Texas, and Sam, the seller, offered it for sale. It was it was a property he held as a landlord, and he sold it to Barb, the buyer, for $91,900.
We've changed the names. She'd actually put down $5,000 in this property, so that means that there's $86,900 owed. She did not get a bank loan. She agreed to make payments to him directly, which he obviously also agreed with. And so they negotiated where he would carry back a note. And she gave him $5,000 and she carried back a note. And the terms of the note were agreed upon. And he acted like a bank. Matter of fact, she paid him $800.29 every month. And it was a 9.5% interest rate, which is written in the note. And that meant she would keep making payments for 249 months, and then she would own the property free and clear. So that's a good deal for him because he's getting 9.5% on his money.
Absolutely. So 6 years went by that Sam, the seller, was happy getting that $800 a month. And Barb the buyer's balance went down to 86,900. Went from 86,900, went down to 75,834.91.
That's crazy, right? So
Yeah.
after all those payments, that's all it went down. But that's because that's interest. She's mostly paying interest.
Yeah, she paid over 57,600, but her balance is only reduced by 11,066.
Decide which side of the cash register you want to be on, people.
Absolutely. So Sam the seller got that 9.5% interest. The principal balance went down just a little bit. Barb the buyer was happy because she's got this property and she got appreciation and got to own her home and everything. But now Sam the seller would like to get some cash out of this deal for another investment.
Yeah, typically what happens is the person carries back a note. They're super excited. They're very happy to get earn 9.5% on their money. And then something changes in their life, and it's either a need or a want. They need money for something like pay taxes, or they need it for a business, or they need it for medical reasons, or they need it for whatever. Or they want to go buy a boat or travel the world or pay for their grandkid to go to college, whatever it might be. And so the only thing he has right now is he's getting that monthly payment, but he can't go, hey, can you mail me $20,000 next month or something like that to Barb the buyer. So this is the note that we see. This is the moment in time that we enter as note buyers, and we get involved with the note. So the property was the $91,900. The down payment was $5,000. The note amount was $86,900. And we know that they'd already been making payments for a while. We know that her balance was down to the 75,834. And that's what we're going to buy. We're going to buy that debt, if you will. It's the owed of the 75,000. We're going to buy that and step in his place, and we're going to pay him something for that.
Yeah, so we're going to say, Barb the buyer, you owe 176 payments. The principal balance is 75,834. We can buy that note from Sam the seller. Now, we like to see that Barb the buyer's made some payments, and she has for 6 years. We also like to see she's built up some equity. If you take the balance of 75,000 divided by the sales price, you're at an 83% loan to value. But in this case, the property value had gone up to over 100,000. And so we were really more like a 75% loan to value. So the cool thing is this note was offered for sale, and we agreed to purchase for $68,430.
Yeah, so I just want to pause here for just a second, because this is a lot. this is a lot of numbers. So I want you to understand that the existing cash flow right now is $75,834. That's how much she owes. So she decided to pay off the note that day. That's how much she owes. She has 176 months remaining of the note at $800 a month. So what we're doing when we say we buy notes at a discount, if we were to pay $75,834 for this note, we wouldn't, but let's just say if we did, we would get 9.5% on our money. That's because that's what the note's written at. By purchasing the note for something less, but getting all of the payments still, our yield goes up in the calculator. It's all behind the scenes. We can't change anything for the payer. We're not going to change her interest rate. We're not going to change her payments. Nothing changes, but we're paying less money for the same cash flow. So they offered us to buy this note for $68,430. So you can see that's $7,400 less than the Barb the buyer owes. And when you put all that into our calculator, which isn't that hard, and we teach everybody how to do that, our effective yield on that same cash flow is 11.36. So we're buying a note secured by real estate that has roughly 26% equity above what we're paying for it. And we're getting an 11.36 yield. Yeah. That's why we love this industry.
That's why this industry is cool. And there's one more piece. If it pays off early, your yield goes even higher because you get your discount back faster.
It's not.
So that's an extra payday.
Sometimes you'll buy a note like this and you'll tell the seller that you bought the note, and literally 2 months later, they're like, oh, I went ahead and got a regular borrower. Yeah. I went ahead and just got a regular loan. And guess what? If she goes and says, hey, what's my payoff? It's $75,000. And I paid 68. So I turned 68 into 75 overnight.
Yeah, and we don't buy them expecting that to happen. That's just a little extra bonus. We're very happy for Barb the buyer to make her payments for the next 176 months and for us to get that higher yield. And we're getting the higher yield, just like Fred said, because we bought it at a discount. So she's still paying 9.5%, but we're earning over 11% backed by real estate. Personally, me with control issues, I'll take that over the stock market.
Yep. And there's also things we're going to talk about in some of the other lunch and learns. You know, we could buy smaller mark. We could buy the next 60 payments. Maybe I don't have that much money to invest, so we can talk about all different things. So there's a lot of creative a lot of creative ways in this industry. You can buy and hold notes just for the income, the interest income, like we saw in the last deal.
You can find a note and wholesale it like you might wholesale real estate, refer it to another investor and earn a fee at closing.
Yeah, that's where I started, was the flipping notes. So I didn't have the money to buy notes when I started. I was in a 500 square foot apartment, and someone says, "Hey, you can buy this note for $50,000." And I'm like, "Well, that's cool, but I don't have $50,000." So I just, since I knew what I knew and I knew what I had learned here, I would fill out some information and give it to a funder, and the funder says, "Okay, I'll pay this much." And so I would make $2,000-3,000 just by putting the two together. So if you don't have your own money, or you're just starting out, or you just want to learn on somebody else's dime for a little bit, flipping notes is a great way to do it.
We alluded to this partial idea, and in our next webinar, when we talk about the four main ways you can profit from notes, we'll go into a really great case study on that. But that's where you might buy all of the note and sell part of the payment. So we could say, there's a 30-year note, we'll buy 15 years, or we'll buy all 30 and sell 15. So partials are the way to recapitalize in the note business. Very powerful, and we promise to cover that in the next webinar, the next Lunch and Learn.
Yep, and there's a lot of other creative strategies.
Yeah, so we love this note business. Today, we just kind of wanted to explain what it was and what kind of market is out there. And the next session will be coming up on 4 ways you can make money with notes. And we invite you to tune in next Thursday for that. And we will show you 4 different ways to make money on that exact same note. And then we'll show you a couple other examples too.
Yep. We're gonna it's this show me the money.
Oh,
episode,
yeah, I
isn't
like
it?
that. Show me the money. Yeah. You can find Fred and I at noteinvestor.com. And if you go to noteinvestor.com/101, we'll be sure to send you some great free items along with examples that you got to see here today.
Mhm.
So we really enjoyed being here with you today. Do we have any extra Q&A that we haven't covered yet?
We do not.
Excellent. Well, the note business has been good to us. We like to say that we wouldn't have stayed in it all these years if we didn't love it. We wouldn't have met each other if it hadn't been for the note business,
True.
I don't think. And we are really excited now to be able to share this with other people because somebody shared it with us. We both had mentors that showed this business to us.
Mhm.
And we are honored to be able to share it with you. And we think there are more people there should be more people that get to take advantage of earning interest on real estate besides the banks. So this is the way to take what happens on Wall Street to Main Street. And that's really what these Lunch and Learn sessions are all about.
Yeah. All right. Well, thanks everybody. Appreciate you tuning in, and we will be back on the next episode. And bring your questions because we'll be here in the live chat answering them as we go along.
Happy note investing.
Bye, everybody.